Hi, my name is Cliff Walsh, and I'm the Vice President of Asset Management at American Portfolios and Portfolio Manager of the 9 Points Investment Strategies. I'd like to give a quick overview of what we're seeing in the financial markets today as we look out through the rest of 2019. Following the worst month in the U.S. stock market since February 2009, December saw the S&P 500 down more than 9%. A deceleration in global growth, interest rate hikes, and increased political tension are all to blame for the lackluster returns. We head into 2019 with an uncertain growth picture. We're at the tail end of the benefits from the U.S. federal tax cuts as it relates to year-over-year earnings growth. S&P 500 consensus earnings expectations have dropped from 11.5% in September to roughly 7.5% in December, a dramatic downshift. And we're of the opinion where there's smoke, there's fire. Earnings season is just getting started, and we've already seen a wave of guidance cuts. Apple cut revenue guidance, Macy's, Barnes & Noble, FedEx, American Airlines, and Delta all cut profit guidance. Besides a cloudy earnings outlook, there's greater uncertainty surrounding the Fed, the corporate debt cycle, and global trade agreements than we've seen in quite some time. Given the growth slowdown that we discussed earlier, there's been a dramatic shift in rate expectations in the futures markets. We've gone from expectations of a solid 2 hikes and potentially a third to basically the rate hike cycle being done as far as the futures markets are concerned. Futures are indicating a higher probability of a 25 basis point rate cut in January 2020 than another rate hike in 2019. We think the Fed's course of action will be a major driver of market activity in 2019. This should not be a surprise. A pause in or completion of the Fed rate hike cycle could help postpone the end of the economic cycle. But regardless of how many rate hikes the Fed gives us this year, the Fed will likely continue to reduce the size of its balance sheet. At the current pace, estimates project this equates to 75 basis points in hikes per year, not to mention there's a lag effect to the Fed's actions. Many previous cycles still rolled over after notable pauses in rate hikes. As we assess the fixed income markets, the Fed's outlook and actions will certainly play a significant role. That being said, we think the market may be surprised by how important the corporate debt refinancing cycle will be in 2019. The non-financial corporate sector has never been this highly levered. The year begins with the start of a 5-year rollover calendar that totals roughly $4 trillion of debt maturities, roughly 2/3 of which are only one notch above junk status. We think this will prove to be a formidable headwind for investment grade and high yield borrowers alike. About 20% of the $485 billion of BBB 2019 debt maturities are in the lowest rung, BBB-, which could prove to be particularly problematic. I think we need to consider how these companies will allocate capital going forward with these maturities taking place. It appears likely that in order to avoid credit downgrades, debt paydown will take precedent over growth initiatives such as CapEx and maybe even employment and new hires, as well as share buybacks. With the absence of share repurchases, which has been a bright spot for the equity markets, we are concerned about what kind of pressure this potential shift in financing priorities can have on the financial markets and overall economy. The trade war with China is also likely to come to a conclusion at some point this year. We think China's precarious economic situation is the catalyst to get a trade deal done. The tariff increases that the U.S. imposed on roughly $200 billion of Chinese goods has been postponed until March. Given this, a new deal doesn't appear imminent, but more likely to occur late in Q1 or Q2. It was a welcome respite, but it remains to be seen how much actually gets tackled in a new deal. Intellectual property rights are likely to be a major sticking point. If a deal does get done, expect the markets to react positively, with emerging market equity to lead the way in performance. The U.S. dollar would also likely be weak, boosting commodities as well. In summary, we expect another year of difficulty and volatility, albeit not without opportunities. While valuations are certainly more attractive, having ended the year near its lows, earnings expectations are also declining. We do anticipate the Fed becoming more cautious. We think a pause is very possible in March, but even if the Fed reverses course and starts lowering rates, history shows it's more prudent to buy closer to the final rate cut, not the first one. Since World War II, the S&P 500 averaged a bottom roughly a year after the first rate cut. So I would caution you that even if the hike cycle is over on the surface, the effects are still to come. We're more confident in the potential for positive investment returns in the first half of the year than the second, as we believe there is a potential short-term tailwind from the year-end 2018 pullback, coupled with the potential for a trade deal with China. In the back half of the year, we may have to contend with a rate hike, a further downtick in growth, and a shift in corporate use of capital away from share buybacks. That being said, no one knows what the full impact will be from the government shutdown, which could weigh on economic activity early in the year. While a recession might not manifest in 2019, recession risk is rising, and we detect a shift in market conditions as well. In 2018, there were 10 more trading days with negative 2% moves in the S&P 500 than positive 2% days. This increased downside volatility is typically more characteristic of periods of crisis than the Goldilocks expansion that we experienced for so many years, perhaps signaling the end to the buy the dip mentality of the market. We're certainly wary of this as we navigate 2019. We're more likely to fade rallies than buy dips in the year ahead. I hope that you found this market commentary helpful. As always, please feel free to reach out to me or Manager of Due Diligence Sam Rozzi if you have any questions or would like to discuss 9 Points Investment Management. Thanks for watching.